So the strongest argument we have with the government to continue to have a strong industry that can be sustainable is that there is underinsurance. So we said to the government, let us self-regulate. So the first point that I haven't communicated well publicly is we are under pressure to self-regulate. And the flip side of that coin is if we don't, I believe we run a very high risk of the government coming down on us with a very brutal form of its own regulation. So we have taken the lead to try and self-regulate remuneration and sustainability in the industry. The other issue I've struggled with in a public sense is how do I talk about sustainability? And I've said this to Richard and to Brad and a whole lot of people. My concern, and I know this is now live and public and apparently I'm being streamed. Is that live streaming, Mike?
Yeah, live.
Yeah. Considering you have a gas-powered typewriter back in the office, I don't know how your staff convince you to do this. But, you know, we have to have a sustainable life insurance industry and we have to have a sustainable advice industry. Why have I struggled to say that publicly? Because many people will interpret that, and many people who don't have any care for the sustainability of our industry, and a lot of those exist in some of the feral elements of the consumer sector, they don't want to hear us talk about sustainability because when we talk about sustainability, we're talking about money in our pockets. But if we can't make insurance work and if you can't provide advice and provide people with insurance, then there is no industry. And insurance, of all the products we offer, I firmly believe insurance is probably the greatest public good that we offer. The more people who are insured, the more people who use that insurance in times of crisis, the less pressure on government and the less pressure on government budgets. So we are a social good, there's no doubt about that. So we have to have a sustainable industry, and you have to have a sustainable form. Advisors have to have a sustainable industry as well. So what are the issues that are important for us in terms of sustainability? We want to ensure, and this is where our framework is moving to, that we can survive in the following circumstances. First of all, APRA is in the process of introducing a set of new capital standards for insurance in Australia. Those capital standards are uneven. That's not a criticism of APRA, that's just the way they're being introduced. They're uneven and they affect different insurers in different ways. But the first point is the pressure on insurance companies is that we have to increase our capital requirements more or less across the board. So that's a pressure on our industry. The second important issue is there is an increase in lapse rates. Now, as you know, insurance is priced as a product to be renewed on an annual basis for a long period of time. It is not sustainable if the product only has a short lifespan. If it has a short lifespan, then prices for premiums will simply increase. And we are finding, as an industry, and advisors will be observing this themselves, that lapse rates are increasing, putting upward pressure on premiums. And if life insurance is too expensive, nobody will buy it. So there is a direct connection to our sustainability, to the pricing of life insurance, to the people's ability to buy it. So our framework is, and I just want to look at lapse rates in some detail. Lapse rates have increased in the 12 months to March 2012, and the termination rate at March 2012 was 13%. And what's particularly evident with upfront commissions is we believe that we need a more sustainable way to remunerate in the face of increased capital standards and increasing lapse rates. So our proposition with the FSC insurance framework is as follows. It will place downward pressure on premiums, and that is good for consumers. It enables advisors to be remunerated for the work involved in advising and putting a life policy in place, and that is good for advisors. It will not capture fee for service, and we haven't communicated this clearly, but it won't capture level commissions either. So that ensures flexibility and for both advisors and consumers in the way they are remunerated. It better aligns the interests of consumers, advisors and insurers, And this is what the government is asking us to do. Once again, this is good for the industry in the long term. Now, we have, for the last month or so, since the policy was announced in early August, been engaging with the AFA and the FPA, the respective chairs, CEOs and policy directors of those two organisations, and the FSC with a series of our life insurance company CEOs, myself and my team, to talk about how we implement this. And as Richard will outline to you, the AFA has put some different views on the table about how this could work. And we'll talk about that in the discussion process in the panel a bit later on. But certainly one of the issues that has been put on the table is the issue of hybrids. And we are discussing the applicability of hybrids to our framework at present. I'm not able to tell you where we're at with that because we have an agreement with the AFA and the FPA that we'll work through this together and seek to reach a consensus. Why is it important that we seek to reach a consensus? It's important because if the government doesn't see a unified view, then that increases the likelihood that they will legislate over the top of us. The other important point to make is ASIC, as you know, has expressed a public view on this. And I don't mind telling you, and I know that now a number of companies around this room have now had this message, particularly from Commissioner Peter Kell, and that is they expect us to deal with the issue of churning. They have identified the issue of churning and they want us to deal with it. And they've sent a very clear message, both privately and publicly, that they believe that our framework deals with that. APRA, although not willing to publicly make a statement, is obviously concerned about the ability of life insurance companies to maintain their capital position in the face of changing lapsing rates. So there is some pressure also from regulators to deal with this issue. So as we move forward, we hope that in the next couple of weeks we will reach a position, and that's our objective, of agreement with the AFA and the FPA. But the life insurance industry in Australia, represented by the Financial Services Council, comes to this position with a united view. We do need to change the remuneration structures, or at least price them in a fashion that provides for higher rewards some increased level of risk. So at the moment, as the way the insurance framework is balanced, if you take a fee-for-service arrangement, there is no clawback. If you take a level commission, there is no clawback. If you take an upfront commission, there is an extension of the existing clawback arrangements. As you know, the standard in the industry presently is a 100% clawback for a lapse in the first 12 months. Our policy seeks to extend that to 75% in the second year and 50% in the third year, and zero from that point on. The work that we are having done at the moment by Towers Watson Actuaries, which will be available, we think, in the next 10 days or so, we are confident will support our strong view that premiums, the pressure on premium increases and indeed the potential for premiums to drop will be facilitated by this approach. Now, one of the other issues that's got a lot of air is how the ACCC will approach this. And I know that I think Don Trapnell has said in the media that he'll take this to the ACCC. We will take this to the ACCC. And that's not in a punitive sense. For this framework to be put in place, it's critical that the ACCC be engaged in the process. And their test will be a very straightforward test. Is this remuneration structure to the greater benefit of consumers? That's the ultimate test that they will put forward. They'll have pressure from ASIC, possibly APRA, that's a matter for APRA, and the unified life insurance industry arguing that there are benefits for consumers that will flow from this. Now, to take you back to the beginning, why are we going down this journey? I want to quote again, I want to quote from what the Minister said. In August 29 last year, almost exactly a year ago, when he released the draft FOFA legislation. With that, in his announcement, he said, and I quote, with respect to life insurance remuneration, sales and practice, quote, "A clawback provision enables life insurance companies to recover some or all of the commission paid if a policy turns over early. The government will work with the industry and consumer groups to introduce uniform clawback provisions to remove the incentive for some advisors to shop around for the most generous clawback arrangements." His words, not ours. But his intent is very clear. This is the expectation of the government. Now, some of you may hope and pray that there's a change of government soon and that the Liberal Party in government wouldn't pursue this objective. I don't know whether they will or they won't. But to some extent, there's no turning back now that we're engaged in this debate. The risks of us as an industry, insurance and advice, not being able to join together to offer a unified position are very high. What do I mean by that? The risk is that if we don't provide a self-regulatory framework, the government will legislate over the top of that. And you will have noticed over the last couple of years, this is not a government that has, in our view, taken into consideration some of the important requirements that this industry needs to operate efficiently and effectively and to provide more Australians with advice. Collectively, as an industry, we all think FOFA has gone too far. So I absolutely appreciate that there are a number of advisors who feel they've been kicked around pretty hard by the government over the last couple of years and there's worse to come. And then over the top of that, here comes the FSC and the insurance companies to make our life even harder. I understand that. I understand where you're coming from. But understand where we're coming from when you've got the minister making statements like that and we have one of two choices: do it ourselves or have it done to us. And our view is very straightforward. If you're offered the opportunity by the government to self-regulate, you are foolish not to take it. So, Mike, thanks for being here. I want to reiterate that I am genuinely sorry that if we haven't got the communication right. I have felt constrained, but the constraints are off now, and I'm quite happy to talk openly about where the government's at, why we need to take our own approach, and the challenge for sustainability for the insurance sector. Happy to now move on, and I look forward to any questions, comments or feedback during the panel session. Thank you.